Hey there, and good morning. Sean Richard here, and you are watching SRT Live, and I appreciate you joining me. So, I'm coming to you with this impromptu broadcast because we just got inflation data this morning, and oh my goodness, did it come in smoking hot. We got the CPI, which is the Consumer Price Index. If you've been watching my updates, you've heard me talk about this before, but CPI is basically an inflationary report that measures the price of a basket of goods. So imagine going to the grocery store and buying 25 items, okay? And then every month you go to the grocery store and you buy the exact same 25 items. Well, over time, you're going to be able to determine whether the prices of those items are going up or going down. And so CPI is just that. It's measuring inflation at the consumer level. And so CPI came in really hot today. The month over month reading was expected to be 0.5%. So no, this is a January reading. So December to January, the market was expecting 0.5% increase month over month. We got a 0.6% increase. But what really is front and center is going to be the year over year reading. Market was expecting a 7.3% year over year increase in inflation. And with the hot reading, it came in at 7.5%. And what I really want to bring to you today is how that's impacting the real estate and mortgage markets. So I'm going to share something with you real quick. Let me bring up my screen here. All right. So here we have the mortgage-backed security charts, mortgage bonds, mortgage-backed securities. The little bit of education, if this is the first time you're hearing me talk about mortgage bonds are really what drive interest rates. And they have an inverse relationship with interest rates. When the price of mortgage bonds goes down, interest rates go up. A typical amount of movement that would cause interest rates to start to shift is up or down somewhere in the 12 to 15 basis point range. Well, we had CPI come out this morning, and you can see here that we are down 50 basis points currently. We are down 4 times the amount that we would need to see for just an initial, some movement in mortgage rates. And so this shifts, as you can see, just dropped to 48. This shifts all throughout the day. It fluctuates with the market. So we'll need to keep an eye on this and see where it levels out, or if it levels out throughout the day. But essentially, inflation is the enemy of interest rates because it's eroding the buying power. And so you can see if I scroll down here, this is, daily chart going back to November, right here, November of last year. And so we had a really stable, flat, mortgage bond pricing for a while through the end of December. And then at the beginning of the new year, right at the end of the December and beginning of the new year, we started to see the price of mortgage bonds decline. Rates started to rise further. And then we rebounded, came back down, rebounded, and we are now slipped down even further. And so inflation is going to continue to drive rates higher. As long as we're seeing inflation increase, then we're going to see rates drive higher. The Fed is looking at enacting some monetary policy in March to help with inflation. They're talking about increasing the Fed funds rate, which is the short-term lending rate. So a change in the Fed funds rate does not have a direct impact on mortgage rates. Mortgage rates, as you can imagine, are typically longer term rates, 15, 20, 25, 30 years. The Fed funds rate is short-term lending. It influences the rate at which banks lend overnight to each other. So it doesn't have a direct impact, but because it impacts the economy, and the economy impacts mortgage-backed securities, which ultimately drive interest rates, then even though it doesn't have a direct impact, managing or changing the Fed funds rate does have an indirect influence on interest rates. So if the Fed increases the Fed funds rate to try and combat inflation, as inflation peaks and starts to come down, we could see a little bit of help in the mortgage-backed security market and ultimately interest rates. However, there's a but. The Fed has also talked about reducing its balance sheet. The Fed has been buying mortgage-backed securities and U.S. Treasuries, and that has been propping the price of mortgage-backed securities higher. So if the Fed starts to reduce its balance sheet, they start selling mortgage bonds, then the price of mortgage bonds is going to come down, and that's going to drive interest rates higher. Think of it as a stock. You know, if you watch the stock market, if you participate in the stock market, when a lot of investors, institutional and private, start selling a stock, what happens to that stock price? That stock price is going to come down. Well, mortgage-backed securities, mortgage bonds, works the same way. If mortgage bonds are being sold at high volumes, that's going to drive the price of mortgage bonds down. And because they have an inverse relationship with interest rates, that's going to continue to push interest rates higher. So even if the Fed starts to increase the Fed funds rate to combat inflation, if they start selling the assets on their balance sheet, including mortgage bonds, we could see that continue to push interest rates higher. So very interesting dynamic over the next 30 to 60 days to keep an eye on. But I wanted to come to you and bring this news to you this morning. Inflation red hot, driving interest rates a little bit higher. You know, if we scroll back up, we've calmed down a tiny bit, but 42 basis points down is still a really, really big move down. So let's keep an eye on it. If you have any questions or you want to learn more about these charts, if you want to learn more about the interactions between mortgage bonds and mortgage rates, reach out to me. You can connect with me at my contact information below there. Feel free to post in the comments below, ask questions. Thank you so much for joining me on this Thursday. Have an incredible rest